Welcome to Sprott Media. I'm Albert Liu. I'm joined today by Nomi Prins, the former investment banker and author of Collusion: How Central Bankers Rigged the World. She speaks and writes about relationship between Washington and Wall Street and presidents and bankers. Nomi Prins will be headlining the Sprott Symposium in July in Vancouver. Nomi, welcome to Sprott Media. How are you?
I'm great. Thank you so much. And I'm really excited about the conference in Vancouver.
Thank you for joining me today. I know that you're busy just coming off some travel, so why don't we get to that? You were in London a few days ago covering the EU parliamentary elections. Can you tell me what your takeaway was from what happened over there?
Yeah, I mean, it was a bizarre sort of week and a half that I was there leading into the parliamentary elections. So the first elections that occur in general between the 23rd and 26th of May happened in the UK, and then they sort of go to different countries throughout those few days, and all of the results are kind of kept until the end. So they're kept on until the Sunday night. So there was a lot of sort of tension within the country, particularly in the UK, in those few days, because leading into those elections, Theresa May had resigned from her post as Prime Minister. And that's going to be effective on June 7th. But the entire week before that, there was a lot of chatter about when that would happen, what that would mean for the Conservative Party, which she leads, who could be the leader. Kind of similar to our elections upcoming next year. There's about 20 people, give or take, who want to be head of the Conservative Party in this interim period. And so there's a lot of conversations about those. And the sort of rise of the Brexit Party, which is a new party headed by Nigel Farage, which kind of came out of a dissatisfaction on the Conservative voter side and within the Conservative Party as to how they were handling Brexit, which is that Theresa May had 3 different agreements that she brought before the House of Commons. There was no agreement within her own party or with respect to the other parties about accepting any of those as to how Brexit could look, or if another referendum on Brexit itself should happen in the UK. So a lot of turmoil going on.
Nomi, let's talk about your book. This is a tantalizing title. I'm going to bite on it. Collusion: How Central Bankers Rigged the World. They've certainly rigged the currency. They've rigged interest rates. They've rigged consumer price indexes, currency exchange rates. How have they rigged the entire world, though?
Well, one of the few sub-themes that I have around the major theme about central banks colluding to rig interest rates, to flush basically cheap capital into the system in exchange for assets around the world, particularly the G7 central banks, but also China in different ways, is along the decade plus that this has been going on, there has been other ramifications that we don't even really see day to day, but that have accumulated. And one of those, for example, is inequality, which has increased both in the United States and with respect to the southern and sort of northern and western countries in Europe, with respect to different countries relative to the rest of the Asian region and so forth. There's been more of an accumulation of capital to the top and less of a foundational economic solidness at the sort of bottom of localities, communities, states, nations, and on a global basis. What that's done is incur more sort of strife on the voter level to leadership in these countries. So the Fed comes in and it says, all right, well, we're going to fix the banking problem in the US. And by the way, we're going to need the crux of the financial crisis began in the US. It was exported on a global basis because of the codependency of the global banks. So that happens. They throw in trillions of dollars. We get to a $21 trillion subsidy on a global basis from central banks to financial assets and banks in the world. That creates more inequality. That creates more voter disenfranchisement in all of the different countries. That creates voting patterns and that go towards sort of new populism, that go towards nationalism, that go towards leaders that can do things like create trade wars. So there is a link from everything that happened with respect to, and I talk about the specifics along the lines in my book, of the major central banks and superpower economic nations that house them. And everything that's transpired really since then, because ultimately economic impacts are felt on the ground, even though financial sort of subsidies are potentially, acquired from the top and for the top. That creates all of what we've seen. I think there's a tie to electing someone like President Trump, who appealed to the popular side and still does. We're talking about immigration policies leading to a trade war potentially with our close neighbor, or at least a proportion of one. It leads to Brexit. It leads to the UK saying, look, we don't want to be told what to do by the EU. We're not feeling the love here financially. Something needs to be done. We're going to change our voting preferences. We're going to vote whoever it is out, whether that's moving to the right or the left. It just happened in European elections where we're pan-Europe, and it's been happening. Voters have been voting out sort of existing establishment politicians and policies and in favor of both the right and the left. So all the polarization that's happened on a political and an economic and an individual basis throughout the world, I believe has been tied to how the financial crisis happened and how it was handled by, and is still being handled by, the major central banks of the world.
When the next financial crisis comes, it's inevitable, we don't know when, should we expect a similar response from central banks or even more powerful response from central banks?
That's a really great question. Central banks don't know what else to do to potentially stave off another leg or a more acute financial crisis. The situation we have now is over the last 10, 11 years is there's been an accumulation of debt that didn't even exist to the extent it exists now before the last financial crisis. And a lot of that has been fueled by central bank policy over these years. So for central banks to turn around and find a way to diffuse that debt or not make it as expensive as it could be if rates were to become somewhat normalized, would be to create a major debt crisis. It would also be to create a major stock market implosion, and that doesn't even count what's going on politically or with respect to trade wars and slowing economy. So the only thing they know how to do in the current setup of the combination of global economies, financial systems, and monetary policy is to continue to do what they've done. And that's one of the reasons why expectations in the U.S., for example, right now, with the Fed having sort of been the break. I mean, they led rates down, and then they tried to lead rates back up. They created a massive quantitative easing, and then they tried to unwind it first. So they sort of led these last 10, 11 years of global monetary policy, stopped in the beginning of this year from hiking rates, because at that point, along with all the other external factors, the markets and the financial system were choking or were looking like they could choke. There were actually a lot of meetings that happened in the end of December, and public purchases, well, not public, but you can go, I went through the reports of banks buying treasuries, because the anticipation of banks was that the Fed would have to hold off on raising rates anymore, or they would have to cut rates. The expectation now is they might have to cut rates, and it's kind of baked into the cake right now in terms of Fed funds rates. That said, I don't think it's going to happen tomorrow. I think there is also a sort of political thing, an ego thing going on between the Federal Reserve and the White House in terms of who's really independent of whom, or if they are. But both of them are dependent on watching markets. And I think if we continue to see another month like May, or another 2 months like May, in any time between now and the end of the year, there is a real strong possibility the Fed's going to come in and reduce rates and cut rates, and a strong possibility the same thing happens throughout the world, that the European Central Bank's going to do that, even with a leader who may appear more hawkish going in. And the Bank of England, who is on hold now, may, even with a leader who looks more hawkish coming in, or a new one, when they do, may turn around and ease rates or buy more assets, do more quantitative easing to compensate. So it's a long answer, but the reality is they don't know what else to do. They do know that creating money or cheapening money or buying assets does have the effect of raising markets. That has the effect of making people and governments feel better. And so I think that is what they would do in a pinch. And they would do it by more, because they're actually starting from a position of higher debt.
Right. And what concerns me is when you have, some very bright individuals getting creative about the way they're going to inject inflation into the economy. If taking the short-term rates is not enough, if asset purchases on the high end of the yield curve is not enough, if outright buying equities is not enough, I'm just wondering, what could they possibly do next? Any thoughts? You want to speculate as to what that could possibly be?
Well, yeah, that's a really good question. I think, for example, in the U.S., there hasn't been equity purchases. There's been discussions internally at the Fed and around the Fed of potential equity purchases or relaxing the rules. So it's like every central bank that hasn't done something someone else has done has the ability to do that. The U.S. could do that. European Central Bank that has been buying corporates could buy equities. Japan, which has been buying equities, and basically the Bank of Japan owns, a substantial amount of the government debt in the country, could turn around and buy, sort of public structures. I mean, they could turn around and buy, portions of infrastructure building, or portions of housing, or portions of just more sort of the companies, whether it's equities or whether it's their inventory or whether it's, extended loans beyond corporate bonds. I mean, there's different ways of you kind of keeping on track with this idea of quantitative easing, of because there are no limits to quantitative easing. The limitation was just, we think we should stop now. There's no legal limitation to quantitative easing. There's no legal limitation in any country, for any central bank to stop doing whatever they think is necessary to do. And so I think you start buying anything. You go from financial assets to real assets that help the corporations that make up your market.
President Trump got really close, at least in his rhetoric, to getting involved, sort of crossing the boundary, getting involved more than a typical president would with central bank policy. I'm wondering, if the crisis got really bad, would there be support in the public for either Trump in a second term or another president to get even more involved than Trump got in his selection of Powell and in his criticism of Powell?
Yeah, it's interesting because he did push Powell, and of course Powell was already an insider at the Fed. So we have to remember that Jerome Powell's decisions before he became the number one person at the Fed, as the number two-ish person at the Fed under Janet Yellen, was basically supporting everything she did. And what she was doing predominantly was keeping rates low and increasing quantitative easing until it sort of died off, and she started to sort of dabble in raising rates, and he continued that. So the path under the last White House and this White House is basically to support the idea of a leader who does keep rates low when they need to, and who does buy assets when they need to. Powell could do that. He did show that he did that in the beginning of this year, when he went very quickly from publicly claiming that there was a little bit of inflation, raising rates, et cetera, and that more rates, as well as the rest of the FOMC said, could happen this year, and then they didn't, because he saw what happened. Trump coming in on top of that is saying, look, I'm paraphrasing, but basically he's looking at the markets, which he connects to the economy and to people's perception of the economy at any rate, and saying, look, when rates were low, the markets were doing better. Rates started rising. Well, the markets were still doing better because they were still low enough, but he recognizes the relationship between cheap money and the appreciation of financial assets. But so would any White House leader. And so I think what's interesting is that there's a community on the Democratic side, and they don't talk about the Fed or rates that much right now, and the only people who does is actually Bernie Sanders, but of MMT, of this idea of sort of a different, sort of modern monetary theory, which is the concept sort of cheapening money, but for the public. But that still increases debt. It's still kind of strategy-less. And so the policies could be similarly supporting cheap rates by anyone who's running the Fed, asset purchases if that's necessary to keep rates down by anyone who's running the Fed, regardless of who is trying to get the vote, whether it's Trump or whether it's whoever the nominee is ultimately on the Democratic side. I think people do believe there's a connection between low rates and high stock market prices. I think many of them still do believe that should connect into the economy. I don't personally believe it does connect to the economy, and that's the disconnect. You can pump up stock prices all you want. It doesn't necessarily mean the real economy is doing well, but that's the perception. So I think people could really vote for either one of them and believe it's going to link into a Fed that's going to continue to basically do what the Fed has done for the last 11 years.
Nomi, while I still have you, let's talk about the Sprott conference in July. Begins July 30th. You're going to be headlining for the first time. Looking forward to seeing you in Vancouver. Wondering, can you give us a hint as to what you might be talking about on the stage there?
I think a little bit of what we're talking about, but what I'm looking at going forward on the stage is seeing, what's gone wrong. We kind of know, and I can summarize that quickly, I think. But what could go right? Like what's actually a path out? And where in the meantime can we look at both investing and like the positive parts of the world where there is kind of a little bit of a growing collaboration between sort of left-wing and right-wing policy on the political side that can tie into a good economic policy that can actually be more of a solid future economically than the sort of chaotic financial remedies or so-called remedies that we've seen over these 11 years. So moving sort of beyond status quo central bank policies to what we could see if we got things right for the real economies.
Sounds like exactly the medicine we need right now, Nomi. Thank you very much for joining me on Sprott Media. Folks, if you'd like to see Nomi and a bunch of other great speakers in Vancouver, go to sprottconference.com. If you use the discount code Collusion at checkout, you can sign up to get a free copy of her book, which she can autograph for you at the conference. Nomi, great to see you. Look forward to talking to you again soon.
Thank you so much, and looking forward to the conference.